We're expecting the S&P to decline further this week into the Friday. Today's the 11th of June. There's several big reports, and Powell speaking. There's probably a low at the end of the week, and then we have certain very short-term signals indicating starting next week the market would rebound and go up again until the end of the month. This is all very short-term stuff, and it's important to see the short-term in the context of a larger picture, because ultimately we want you to see that this correction, even though it's hanging around the highs, it even may make new highs, it still is part of a correction. It's called a B wave. And we're expecting a C wave decline in July, which is a fairly, it should be a bigger, more dramatic decline than we've seen so far. But once that July decline is over, the market should rebound and continue much higher after July 25th or early August. Okay, we're expecting a rally at least till September and probably into sometime next year. So several pieces of information we want to add. Number one, the short-term picture, the 707-hour cycle has been repeating really well. And if it continues to repeat, we'd have a little high here on the 11th. It should come down for a few days into the end of the week and then resoundingly go up again until late June. Okay, that's super short term. On the longer term, we mentioned this in our clinic last week. We're starting a new course on Sunday, this week Sunday, on June 16th. And it will be an ongoing 3-month program, 13 weeks. And you'll have the opportunity to understand exactly how we do what we do. Okay? So, going back to the longer term picture, the 30-year cycle and the 20-year cycle have been running the show for the S&Ps and for the Dow for 100 plus years. And we need to see what the 30-year cycle is doing. So we have a pattern recognition program called Navigator. It's no longer available apparently, that allows us to see the pattern in the most recent 12 months and compare it to the prior history of the Dow. And note, by the way, the Dow has been much weaker than the S&P. The S&P is making new highs, touching on the highs. The Dow is not anywhere near the highs that it made a few weeks ago. Okay, this is important. And these patterns are from the Dow Jones Industrial Average. Similar patterns exist for the S&P. So what we see here is the 30-year cycle is bullish and has a little correction each of the last 4 times it came in. The most recent time came in 1995, and we have in this list of high correlation matches a 92% match, which is very high on the list. And then the 1964 market, which is 2 cycles of 30, is also very high on the list, as well as the 1935 market, 3 cycles of 30. And all 3 have a correction in progress with a correction ending in late July. Also, the 4th occurrence in 1905, 119 years ago, almost 30 times 4, is also showing the same pattern, and that one's only 88%. But 3 of the top 20 best matches are the 30-year cycle multiples, and that's very important to consider. Also notice the summation of those is shown here in this graph underneath. That summation is bullish for a number of months going forward. This particular pattern is 8 months into the future, and it shows that eventually market has ups and downs along the way, but it works its way higher into next year. Okay, so we're looking at a correction, yes. The correction is in progress, yes. We're expecting lower prices, most of them by late July. And until then, we may see additional higher prices. How can we have new highs and still be in the middle of a correction? It easily happens. Happens all the time in a bullish market. The B wave can oftentimes take out the highs of the initial starting point of the correction. And even so, it goes down significantly in the last leg in the C wave. Okay, so that's what we're looking at. And we're looking at a very boring market at the moment. Probably it'll start getting interesting over the next 2 or 3 days. Have a good trading week.